I appreciate your call. And what's more important is go have fun and drive some cars, right? I mean, that's really what this is all about. Aaron and I were talking about it. Your lease is coming up.
My lease is coming up in July.
And it's called, Dad, let's go drive some cars.
That's right. Well, also interesting, I think a lot of people are apprehensive about leases because they don't like payments. Right. But they also have the option to do a one-pay lease, which
is... That's your mom option.
Exactly. So what my mom did was she leased a car for 3 years, and instead of paying monthly on the car, she just paid the full amount of the lease for the 3 years in one payment. It makes it a little less because you get a little discount for paying it all, and also you don't have to pay the interest because you're paying it all at one point. So it helps a little bit.
But she does get driven crazy.
Oh, that's right. Every single month they send her a bill that says 0, which is nice. It's like a bill you've already paid. Congratulations.
Exactly. So it drives her crazy.
So there are a lot of new options with leases.
But she's used to that. You know, I do come home every night. And
drive her crazy?
Well, that is my thing. Anyways, again, Randy, great call. Our phone lines are open, so you know we're live.
That is right, and I mean, I don't know how anyone is going to be able to top Randy's call. That was one of your favorite questions to answer.
You know, I think it's great, and I think it's fun running through the numbers, and for me anyways, you know, people that say, well, I'm going to keep this car 10 years, like, yeah, okay, if you do, great.
Well,
Start with a new car, and then buy it at the end. If you love the car, buy it. If it's a lemon, get rid of it.
Leasing doesn't prohibit you from purchasing the car. It's just an option. It's just, right, like you said, a delayed purchase. And also, essentially, what you're doing is you're paying for the best part of the car the first 3 years that you own it versus when you buy maybe a used car, someone else paid the premium on that.
When you find out that the residual value, that is what they think the car is worth at the end of that lease period, is between 40, especially the American cars, about 45 to 50% if you're lucky, you're going, are you kidding me?
Are you kidding me?
Exactly. Are you kidding me? So, it's up to you. You know, there's no bad decisions here. It's just a matter of, you're right, Randy, to make the point. Payments. Payments are lower with the lease because you're financing less.
Right.
And if you like driving a new car every 3 years, cool.
Right.
There you go. Well, again, our phone lines are open, 969-KTRS, star KTRS on your cell phones, or 1-888-550-KTRS. So while we're waiting for our next caller, you know, we usually talk about things that we see in coaching sessions, and I think that's important because we do see listeners as new prospective clients as well as clients every week. And I thought, let's pull from the mailbag.
The mailbag.
We've been getting tons and tons of really great questions, and we love getting those, by the way, folks, and we do answer all of them within 24 hours, so we do appreciate you doing that. And you can do that either by sending Aaron an email directly, or I, Jeff, or Aaron at jblfinance.com, or just go to our website and hit Contact Us and just write out your question. Or give us a call.
Yeah.
314-863-0008. So we just did receive an email. Jeff and Aaron. At least I put my name up front.
Out of respect,
yes.
Really.
You talked about some... Oops, let's not do that one.
No?
That's the one about Rockstar.
It's a different mailbag
we've got
question.
We've got a couple of these. And this one was, Jeff and Aaron, I'm 64 years old, getting ready to retire next month. I have approximately $525,000 in my 401k at work. Good job. I know I will need to start taking some of this money soon to maintain my income, my lifestyle. How do you do it? Thanks, Jack.
Jack, great question.
There you go.
That's probably the number one question.
I'm jacked up about that.
Got some good ones today.
So let's talk. Well, you know, I did have 3 cups of coffee.
Ready to go.
Ready for action. So, where do you get started?
Well, the first thing that Jack needs to do, find out how his employer will allow him to take money from the plan.
And there's usually, we find 2 ways, right?
Right. Well, yeah, either you are able to do it over the phone with a representative, you have to give some personal information, or you have to do it by paper.
Right.
Or, well, some companies allow online, but that's just another version of it on paper.
Right, so it's either paper. I think it's important to understand how do we get the money from the employer. And, you know, once you've done that, then you have to go to step 2, right? Step
2 is either having an IRA account already created for you. Maybe you had one from a previous employer.
Using
you have
one
at a bank.
Using one that you have in fact
Exactly.
now.
It needs to be a traditional IRA, not a Roth.
Yes.
And or if you don't have any IRA account set up, which is true of many people because they use their employer retirement plan.
Or some, they may decide that they want to go and begin to create a relationship with a new advisor.
That's true.
Like 99% of the folks that we're dealing with.
Exactly. So then either we create the IRA account that's going to accept the money from your retirement plan, because essentially you just have to create a vessel for the money in your employer's plan to be moved into this new account, and they have to be the same type of vessel, so a pre-tax account.
Right. So 401k or 403b going to an IRA. We're doing that because under the tax law we call those direct transfers.
And then also
the trustee, right?
Yes, and to add another layer to that, which is just that now we know that so many employers have now added Roth 401ks.
Right.
You'd have to do the same exact process, except for you would need a Roth account set up to accept the Roth 401k money, because you don't want to mingle after-tax assets with pre-tax assets, then they all become pre-tax. You don't like that.
Now, we know that sometimes people don't want to do it the tax-efficient way. And the most efficient way, again, is to set up an account, an IRA account, and have the money be transferred directly there. But some folks don't do that. There's two other things that you can do. Number one is that you can have the money come directly to you. And the company typically, or your plan sponsor,
20%.
They're going to withhold 20% and send to the IRS, and then you're going to have to try to get it back because
then you also because if you don't move the money within 60 days into an IRA account, then you lost 20%.
That's right. You're paying that, and what happens is you also get to pay taxes on the entire amount because all of it wasn't transferred in.
Ouch.
Not a good thing.
Why would someone? Can you think of a reason?
No.
Why a person?
I've seen it before, but I think it's primarily because it's a trust issue. I mean, the bottom line is that most folks don't realize that there's virtually no cost from a new plan sponsor, whether it's a bank, whether it's a mutual fund company, whether it's an investment advisory firm like ourselves, brokerage firm, whatever. They don't charge you to set up an account.
No,
there's no upfront cost to do that.
No, you have a $35 IRA fee on an annual basis, but that's
that's for reporting purposes by the custodian. But the bottom line is you need a vessel to receive this money. If you do that and you have it gone directly to you, you get a 1099-R in the mail, which is informational.
Says that you moved from a retirement plan, it moved into this number IRA account. There's tax-free transfer, so you're not liable for anything.
That's right. So that is the smartest and the most efficient and effective way to do that. The only reason that somebody wouldn't do it, I believe, is if they just wanted the money.
Oh, that's a good point. I mean, and also there's a couple of
maybe they're closing a small account. They don't want it. They really don't want to do that. But that kind of peripherally talks about questions about, well, what do I do if I leave my company plan? Should I go into a self-directed IRA? Should I move it to a new employer plan? Those are the two smarter options, getting it sent to you, having withholding done, and then depositing it later within 60 days into an IRA plan.
And then trying to get your 20% back because you really didn't owe that if you move it into the...
We call that mishigas.
Too much work.
Too much work.
Well... With
no reward, actually.
That is quite true. And, I mean, after this step, so once you've sent the paperwork or made the phone call to the employer to have the money moved, it can either move electronically, which is the nicest. It moves electronically from your employer plan. They liquidate your assets. They liquidate your investments, move it in cash into your existing or new IRA.
And most folks don't know that either, by the way.
Right. You cannot transfer assets in kind from an employer plan into an IRA.
Yeah, and so what's nice is that there's something to consider here. If you really like the stuff that you're in,
you can replicate it.
Exactly. You should be able to replicate it unless you're working with someone that has some proprietary products that are out there. And there are obviously companies that do that, or they want to send you that way. Our firm is, we work for the largest independent advisory firm in the country, so what's neat is that...
A lot of options.
Yeah.
And or the alternative is they will mail a check that is in the name of the custodian. That's the bank that has the IRA, and and your name, so that means that only the custodian can cash it in your name, put it into your account in your name.
Yeah, so as an example, if I was to retire, don't get any idea.
You're gonna say what?
I know what you're.
I have the rollover paperwork prepared.
Okay.
I have it prepared.
Yeah, I hear your mom.
You
Less
hear her?
money, more dad. Forget it. Okay, that's what she's
We'll
saying.
negotiate that
But what would
later.
happen is if I was to do that, my retirement plan check would say LPL Financial, FBO, Jeff Lapidus. Well, actually say
Jeffrey B.
Thank you.
Lapidus.
IRA. So I can't cash that check. The only person who can actually cash that check is the custodian.
And they can only put it into Jeffrey
Right.
B. Lapidus' account.
Exactly. So.
And that is not considered taking the money yourself because
No, that's what we call
that
direct
is
stream.
the direct. Even though you've received the check, that doesn't mean that you did it wrong.
So again, to summarize here, making it easy. Number one is that you need to talk to your employer and say, how do I get money out of the plan? Do I need a form? Can I do it by phone, or is it something I do electronically? Second thing is, do I have an account? Do I need to set up an account to accept the money? Third is, you sit down with somebody. Don't do this yourself. Sit down with someone and do the paperwork.
Yes.
Generally, what will happen is that if you are having the money going to a different financial institution, whether it's a bank, mutual fund company, a financial advisory firm, what will happen is you'll want to have that account number for that new account, the name of the custodian, and also their address.
Right.
Sometimes these are information that's requested. Then also, just an FYI, and I think for your own sanity, find out how you're going to get the money.
Right.
Will
you
they
want to
send
know
it directly to the custodian? Will you be receiving a check in the mail? And then obviously you're making arrangements to have that money invested.
Right, because some employer plans can only send the check to the participant. They can't send it to a third party, which would be considered the custodian.
So I know folks have questions about that, so we hope that helps. So let's go to the second part. We also found out from Jack that he also has an existing IRA, but he also has an SEP. He happens to be a self-employed guy. He has an SEP. And
or he had one from one.
Yes, and so he asked, can I combine these two together? That's a big one, because the IRS does have rules about combining things. So the answer is yes.
But also no.
And maybe no, right? So let's give him the yes part.
So, for example, in Jack's case, he was working for an actual employer, right now he's with a 401k. Formerly, he was self-employed. He had a SEP. It's been sitting there dormant. He's not contributing to that SEP any longer.
SEP is a simplified employee plan, which is basically like a super 401k, but for somebody that is self-employed.
It just gives self-employed people the opportunity to put more aside than just an IRA would allow for.
Right.
So, since he has not been contributing for the past several years to his SEP plan, he actually can combine that with an IRA or with his new rollover money.
So if he was contributing to that plan, if that was an active plan for him, could he roll over the money into his SEP?
No. You would have to roll it into an IRA.
He has to wait.
Exactly. He could create an IRA, and then once he's done contributing to the SEP, he could move that over into the IRA.
Right. And exactly. So there are some rules about this. If Jack happened to be participating in a simple IRA plan, which is a sort of a souped-up IRA plan for companies.
Smaller ones.
Smaller ones, those that have less than 100 employees. We do a lot of these. The answer is yes and no.
Yes, if the plan has been in existence for at least 2 years,
then you can
IRA,
combine it with other things.
as long as you are not contributing.
And I think, again, that's the key. If you're contributing to that plan, you really can't put other assets into it. Especially if it's like a 401k, like a SEP, like a simple IRA.
Right. And also, there's another frequently asked question, which is, can husband and wives combine their account? We're tired of having 6 accounts.
It's love.
We just want to look at one account.
It's just one of us. The answer is
no. That's why it's an individual retirement account, because it's attached to your Social Security number. It's reliant upon your age when you have to start taking required minimum distributions. So in a lot of cases, you really don't want to combine it, especially if you wouldn't want to, rather, because especially if you have a spouse, there's a large age discrepancy between the two of you.
But there is a time that you can.
That is when you knock your spouse off.
When there is only a surviving spouse, that's right. That surviving spouse then has the option to either keep that IRA and make distributions from it based upon the age of the previous spouse, or they can combine that with theirs. And there are obviously some different strategies for that. Let's talk about that next week. That's kind of a fun thing to talk about.
It's a good one. To be continued.
Planning, because everything isn't vanilla.
Right.
We want to simplify things. It doesn't have to be vanilla. So there are a lot of different planning opportunities there. So, Jack, we hope that answers your question. Again,
a few you did not have.
And a few you didn't have. What's important here is get some advice. Get some assistance in this. This is probably one of the biggest, if not the biggest, financial transaction that most folks do.
And then also, this sounds complicated and it is foreign for people that never do it, but if you're working with a professional, this is something that they do on a regular basis.
Always do it right.
Yeah, but there's no reason to have an unforced error in this situation.
Right. And this is obviously a great opportunity for many folks as well. And this is really, I would say, probably the primary impetus in our practice, which is many folks are at the point where they're saying, okay, I've gone through the accumulation phase, but I'm really ready to go into the distribution phase. I need some assistance, advice, guidance, coaching, etc., to go from where I was to that next phase. Doing the interface with Social Security, when do we take it? Doing the interface with pension.
With health insurance.
With health insurance, etc. So this is a great transitional time to happen. So, and this is frankly where we get most of our new clients from, right?
That is
folks
right.
that are listening just like you.
It's time for me to do that.
There you go. So, Jack, we hope that was a fabulous question. We do appreciate that one. Please keep them coming. Again, there's two ways you can do that. Either by going to our website.
Clicking Contact Us at jblfinancial.com.
Or you can send us an email, jeff@jblfinancial.com.